Hey folks, Larry Berman here, and here's what's on my radar this week. Well, as feared, the Jackson Hole speech was as bearish as could be, and risk premiums are up all over the place. It almost doesn't matter what asset class you look for. It's now okay to say recession. It's now okay to say higher for longer. We actually heard, Biden's used the word recession. So, the next couple of months and maybe quarters are going to be challenging for capital markets in general. Are we going to get trading rallies? Absolutely. But the biggest issue here going forward is that we're on the flip side. The Fed was not happy that the market was starting to price in easing in 2023. So his speech pretty much took that out of the equation. So let's have a look at our chart room this week and see what's on the radar. So Fed balance sheet. So you can see going back, early 2010s, big expansion, and then the Fed held the balance sheet steady for a few years. They had talked about quantitative tightening, reducing the balance sheet, but they really started in 2017. And as we know, 2018 was an extremely volatile market for equities and risk premiums in general until late in the year and early in January, the Fed pivoted and ultimately a few months later started to buy bonds back again and expand the balance sheet. Enter 2020, global pandemic, world shuts down, central banks around the world just have to print and print and print and print, and they did. They expanded the balance sheet, and they never stopped. They just kept increasing, increasing, and increasing. And really, until the last couple of months, that balance sheet kept going up. So now we're on the other side of QT. They've started to inch into it. September and onward, now they're looking at taking off 90 plus billion a month. And they've yet to touch the mortgages because they're worried. So how are they going to unwind $1 trillion of balance sheet? At the same time, we need $1 trillion in new funding for deficits and spending, and oh my goodness. So part of the higher for longer is not the size of the Fed balance sheet. This should be a significant negative for risk premiums as we get on the other side of this. But the good news here on inflation expectations is showing us the Fed is starting to get ahead of the curve. And the response on the 2-year forward inflation swap was just that. We saw inflation expectations post Jackson Hole take a notch down. And no, we're not at 2% yet, but it's actually just breached, literally as we're talking, 3%. So good news here, and that should mean that markets don't collapse. That should mean that the Fed doesn't have to keep going and going and going. There'll be a pivot that comes at some point, but I would not expect that, nor the language for that, unless equity markets got really, really stressed. Make no mistake, they want tighter financial conditions. They don't want the S&P 500 puking and having people panic. So, in the bull and bear pick of the week, well, what has underperformed dramatically this year? Gold. And as we said months and months ago, that we were selling into the strength on gold, not because we didn't think inflation was an issue, but it has to do with real rates. And it has to do with competition and interest rates. And as rates are rising and real rates are turning positive, gold and gold equities tend to perform very poorly historically. And that's clearly been the pattern. Now, we were expecting peak inflation a few months ago. We had talked about a few months ago, this period here where we said go into the silver names, go into the gold names. We should get a good rally here. We're expecting the Fed to do that. And you know what? It just didn't happen. Inflation became stickier, and we know June, July were kind of bad months, for equities. Now, Actually, July was a good month. June was ultimately the bottom. So now we've undercut. We've made a lower low. Gold equities and silver equities will rip again, but they will on the pivot. But right now, from a value perspective, go back and look. This was a big trading error. This was capitulation. So I'm thinking the value here is tremendous. We are now in the let's accumulate and let's build a position in all these mining stocks, and in particular the gold and the silvers, so that when the Fed does pivot, and whether that's 3 months from now, 6 months from now, or 12 months from now, we don't know. But we're now accumulating these things at very, very attractive levels. We had cut our exposure significantly months ago, and now we're looking to add that back as we progress into the next 6 months or so. On the bearish side of the equation, what do we hate? Well, let's look at this chart, for example. And if I could cover up the ticker, I would, but you'll all know now this is front month crude oil futures. And if we look at this, folks, this is a topping pattern. It's not a base. It's not a bottom. Anybody who tells you this is bullish, now fundamentally, they're going to paint bullish stories here. I actually think if we're going into a recession, we see 80 or 75 before we see 100. I'm not talking about 2 years from now and what tight oil means and OPEC cutting back. I'm talking about from a trading perspective. So I don't like the energy names here. I'm buying ratio put spreads. I want to buy the dip, but I want to make some money on the pullback. Ratio put spreads on energy stocks is what I like here. Here's the chart that I hate the most. And you'll all know that I've been an advocate and highly outspoken against crypto in general. This is ugliness. And again, the shills out there that are painting this, listen, invite me on to a panel. I'd love to debate you on why this is garbage and what you're pushing to people is absolute, utter nonsense. It should be a criminal offense. However, so I'm willing to take up that debate with you. Bear call here, 10,000 before 30,000. So that's it for the radar this week. Have a great long weekend. Golf, do whatever you like to do, and get ready for a couple challenging months ahead.